Okay, good morning, everyone. So we are going to look at the last chapter of this semester, right? So by the way, so this is going to be the last week, and the next week we are going to have our final exam, right? Okay, so what are we going to do in the final week? So we are going to look at the money, banking, and the monetary policy. So in the previous week we have looked at fiscal policy. So that's in previous chapter, fiscal policy. So both fiscal policy and the monetary policy, they are used or designed to to dealing with economic fluctuation. But they just the difference is they are going to have different tools, right? So fiscal policy so relies on taxes, government spending, or transfer, right? And then so you're going to see today. So monetary policy is going to rely on adjusting money supply or interest rate, right? But before we understand monetary policy, we need to understand what is money and how bank generates money, okay? Or how banking system affect our real economy. So this is the roadmap of this chapter. So first, we are going to look at money, right? And then so the form of money it may takes in the economy. And then so we are going to look at how the Federal Reserve, they're going to determine the money supply. And then lastly, so we're going to look at how Federal Reserve, they use open market operation to change the monetary base. So that is how they conduct their monetary policy. Okay, so this is a roadmap of this chapter. Start with the first topic. So we understand the money. So money plays unique and very important role in modern economy. So the key word is modern economy, right? But actually, so even in ancient days, money exists, but exists in a different form or different way. So money is defined as any asset that can easily be used to purchase goods and service, right? So the goal here is we need something so that we can buy goods and service. And then some money is going to be any assets that it can be used to fulfill your demand to purchase goods and service, right? And think about some interesting case in 1933, after many banks failed. By the way, so this is after Great Depression. Okay? Many banks failed. And some US towns turned to homemade currency, like these clamshell scripts used in small town in California, right? So in this background picture shows, so they use very specific things to use for money, right? If you read this, so they said good for $1 on demand at the rest well cabins, right? So it means so this is going to have $1 value. So this is equivalent to a $1 bills, right? So if we look at the definition of money, right? So essentially, so these clamshells is assets, right? And it can be used to purchase goods and service, maybe in a very specific location. But that is just give you a definition of money. Right? A relative concept to money is called currency in circulation. So that's essentially cash held by the public, right? Like this background picture shows. But at different time, so we have different currency in circulation, right? And the other related terms to money is called checkable bank deposit. So those are bank accounts on which people can write checks. Like essentially, so your money in your debit card. So that is very liquid in the sense you can use whenever you need it, right? Either by swiping your debit card or you write a personal check, right? All right. And so we have talked about three things, right? First is what is money, and then second you talk about. So first we look at money, look at the definition of money, And then so we look at currency in circulation. Now the third thing that we just discussed is checkable bank deposit. Okay, so now we are ready to look at money supply. Money supply is the total value of financial assets in the economy that are considered as money, right? Later on, you're going to see, so the money can be widely defined by including those three things we just discussed. But the money can be narrowly defined by only considering currency in circulation. But regardless how we define the money supply, but fundamentally, so we need to understand what is money, right? We do have a definition. In the following slides, I'm going to explain to you in details, so what kind of assets can be considered as money, or what functions the assets must satisfy to be considered as money. Okay. So money must function as the following three things. Number one, it must be a medium of exchange. So this is used to help us to trade for goods and service. Number two, it must be a store of value. So that just helps us to keep the value of the things we have, right? And the third, it must be a unit account. So this is for transaction, right? Now let's just look at one of them, each of them in details. Start with medium exchange, something people accept as payment for goods and service, and then this defined as medium of exchange. Like in the first example, show you. So that's clamshell. It is a medium exchange because people in that town, they accept that. So they accept that so that they can just consume in a specific stores. So that's a medium exchange. Right? And so this is expanded further by saying an asset that individuals acquire for the purpose of trading rather than for their own consumption. What that means? Again, use the example we show. Right? So we have this, we saw at some point people accept these clamshell as a medium exchange. But maybe sometimes so people just collect these for collection, not for trading. Okay, and then the same things becomes different purpose. Okay, and then in the second case, it's not a medium exchange; it's just a collectible. Okay, because they are not. So they acquire that clamshell is only for their own consumption, like just enjoy the beauty of that particular things, right? It's not for the purpose of trading. If that's the case, so it's not considered as money. Right? Now, secondly, so the money must function as store of value. So money is a means of holding purchasing power over time. Okay? So this purchasing power may decline or increase over time, but it holds some purchasing power. Right? So that's called store of value. So this money enables people to save the money they earn today and use it to buy the good and the service they want tomorrow. So this is called store of value. Okay. Now the last function money must hold is called unit of account. So money provides a yardstick for measuring and comparing the value of a wide variety of goods and service. Right? Like in this background picture shows. So the money as a unit account allows us to compare orange with apple, allows us to compare orange with different origin or different quality. Right? So this unit of account. Right? Now we can look at different type of money. It has been exist in human history. Right? For thousands of years, society have used commodity money. What is commodity money? Commodity money is a good used as medium exchange, but this good itself has intrinsic value. Okay? What does that mean? Just look at examples. Okay? So these two things in these background pictures some circumstance has been used as money. Right? Start with left one. Some prisons use cigarettes as currency. And again, so to consider as currency, it must satisfy three things we just talked about. Number one is media exchange, right? So in prison, so people accept that a cigarette as a media exchange because this cigarette may be useful for most of the inmates, right? So this is the first thing is satisfied. Secondly is a store of value. Okay? So the cigarette can last if you keep them properly, and it can last for months or maybe years, right? So that serves as a store of value. And third, so the money must work as or the media exchange. Sorry, as it must work as unit of count, right? So these cigarettes, so they are identical, so that's a good unit of count, right? But certainly it has its limitation. But just let's wait for the next slide to understand what is the limitation of using cigarette, or generally what is the limitation of using commodity as money. Okay? But then certainly from the discussion I just had, cigarette can be considered as currency. Okay? By the way, so this cigarette itself has intrinsic value because to smoker, so this cigarette is useful. They derive utility or they enjoy smoking, right, by lighting a cigarette. So in that sense, so this is money with intrinsic value, like we call commodity money. On the right hand side, so we have a certain part of the world at a certain time. So they use this big stone, round stone, as currency. Again, so you can apply these three functions to test whether this round stone satisfies those three functions. The answer is yes. Okay, but besides satisfy those three functions we just talked about, so this stone itself has intrinsic value. It can be used as a building block, or it can be used for decoration or other purpose. Right? So this is a commodity money. Now, as I mentioned earlier, so this commodity money has its limitation. Okay, so there are a few limitations. Start with unit of count, right? So let's use right hand side as an example. Okay, so this big stone, so probably is cost lots of effort, so its value can be high, right? But just imagine if you want to use this big round stone to buy an apple, okay? And so you probably should get, so it most likely would be the case, one stone is going to equivalent to maybe 100, not 1,000 of apples. If that's the case, what we are going to do, how we are going to pay the sellers who own the apples, right? So in that sense, so this big stone or this commodity money is not a good unit of count. It is a unit of count, but it's not a good unit of count because it's not easy to divide, right? So in that sense, in human history, so people we have used salt or gold as commodity money, because salt you can pretty much infinitely divide them, and gold at the same things, right? So that's a better commodity money. But in general, commodity money is subject to this constraint or limitation. The other things about commodity money is, so this commodity money has limited supply, right? So because you need create, or you need to produce such commodity, and then you use this commodity as money. So in that sense, it's limited supply, and also it is a waste of resource because we just create these things and only for circulation, right? And the third thing about commodity money is it may not be a good store of value. Just think about cigarette. Okay, so when we live in a humid region, or when you don't have good place to keep your cigarette, and then so it's going to destroy in a few weeks or a few days, right? And similar thing about salt, right? So people use salt as money in ancient days. But what happens if we are in the raining season, okay, and then the soil is going to melt. So the commodity money has its limitation, right? So given this limitation, we move forward. So now we are going to look at a more modern form of money. So this is called commodity-backed money, right? So this is a medium exchange. Again, this is the same as commodity money, but this medium exchange has no intrinsic value. Okay? And so what that means, just look at this background picture. Okay, so this currency looks pretty much like what we use today, but it's slightly different. A difference in the sense, if you read this more carefully, it just says silver certificate. And see, so this is payable to the bears on demand. Some silver. Basically, it says if you hold one piece of this paper and you go to any bank, and then so this bank is obliged to pay you certain amount silver on your wish, right? And then in words, this just says this commodity-backed money whose ultimate value is guaranteed by a promise that it can be converted in valuable goods. And in this case, what is the valuable good? Is silver. Okay, so you hold this piece of paper, because you value the silver behind this piece of paper, and so whenever you go to the bank, so you can exchange for a certain amount of silver as you wish. So that just justifies why you want to hold this piece of paper, because this piece of paper itself has no intrinsic value. So let's just compare with commodity money, right? So these things, so if you hold one cigarette or one pack of cigarette, right? Whether you are a smoker or not, it has intrinsic value. So if you're a smoker, if somebody else don't like it, that's fine, so you can smoke it. Now, if you're not a smoker, and then so you can give to others as a gift or exchange for other goods and service you may want. Right? But then, so in this commodity-backed money, so the paper itself has no intrinsic value. So this intrinsic value is guaranteed by a promise. So that's the difference. Now, so this is better, this is an improvement compared with commodity money, in a sense. So you don't need to hold commodity, so easier to store. And this is a better unit of account, because you can create $1 or you can create 1 cent, or as you wish, right? So in that sense, this is the improvement, but it still has its limitation. Right? In the sense, you still need certain amount of commodity to support this system. And then, so when your economy grows, you need more money, and then your economic growth will be limited by these particular valuable goods you can produce. So that leads to the next improvement, right? So before I show you the next improvement or next generation of money, let's just show you another example of commodity-backed money, right? So this is it's hard to see the date, perhaps like 18 something, right? And then, so if you read this part, very carefully, you can see the essential that it says, if you hold these $5 bills, and then so you're going to receive certain amount of silver on as you wish, right here. All right. So the last generation of money, or the more modern form of money, is called fiat money. What is fiat money? So this is similar to commodity-backed money, in the sense this money itself has no intrinsic value, number one. But different from commodity-backed money, So this money derive its value not from some commodity behind this, not from some promise that you can exchange for certain valuable commodity. So you derive its value entirely from its official status or the law or the constitution. Now, so this law just says, so everyone must accept this as medium exchange. The law grants you the right to use this money for legal purpose, to exchange for goods and service, right? So this is called fiat money. It has no intrinsic value. It has no money behind, sorry, it has no commodity behind this money. So this is fiat money. Now, so if you like, so you may want to discuss with fellow students how the economy would be different if we used only local currency. So basically, so that's going to hamper our ability to do trade with people living in other region, right? So now, given we understand what is money, now we can look at how we measuring money supply. Okay, so first, monetary aggregate is an overall measure of the money supply. Okay? In terms of money supply, so we have different definitions. So in this class, we look at M1 and M2. Okay? So M1 is most narrowly defined money supply, and M2 is more broader definition of the money supply. So in reality, so we may have M3 or M4. So speaking of the money supply, United States or the US dollar is the currency most likely to be accepted for payment around the world, for international trade, for financial inflow or outflows. But US dollar is not the biggest money. Eurozone or euro, in terms of currency in circulation, is slightly bigger compared to US dollar. So this is a matter of facts. Okay. Now here, this slide just explains to you what is money supply, right? Or what's the money aggregate. So this is in 2013. On the left-hand side of this slide, we have M1. Okay, so M1 include those most liquid financial assets that can be accepted or can be used as medium exchange. So the M1 largely consists of currency in circulation. Just think about the dollar bills, coins we have. The other one is checkable bank deposit. Just think about the money we put in our checking account, right? And then there's a small fraction of M1 includes traveler's check. This is essentially cashier's check, right? So when you travel, or when you need to close a house, or when you buy things from a private party, and sometimes the buyers ask you to have a cashier's check to avoid some fraud, right? Because if you write a personal check, if you don't know that person or that business, so they may write a check, cause some overdraft, or the check has a value bigger than what they have in their banking account, right? So this is traveler check. But overall, so the M1 includes currency in circulation and a checkable bank deposit. So those are two big categories, right? So now if we look at M2, so essentially M2 expand over M1, right? So you can see M2 includes M1, right? So the the biggest addition we have in M2 is saving deposit. So this is your money in your saving account, not checking account, right? So what's the difference? Saving account usually has a fixed term, or usually bears some interest, right? So that's saving account. It's less liquid, right? So you need transfer your money in saving account to checking account before you can write your personal check, or before you can swipe your credit card. Yeah. Now the other two smaller things that include in M2 is money market fund and a time deposit. Right? So time deposit essentially is like a long-term deposit you have. So if you have 6 months or 1 year, okay? Or maybe like 2 years. And the money market fund essentially is the money you put in your brokerage account. Like if you invest in stocks, and then so you transfer your money from banking account to your brokerage account, and then so you put your money in that money market fund. When you need that, you need to transfer that money back to your banking account, and then so you can write your check. So it's a little bit less liquid, right? But overall, so both M1 and M2, they are liquid, right? So M1 essentially includes M2. Okay, M1 is include less liquid assets compared to M1. Right. So here, just summarize. Right, M1 includes only the most liquid form of money. Here, so the liquid means so you can use whenever you want or whenever you need. M2 includes near monies. Those are financial assets that can be directly used as a medium of exchange, but can readily be converted into cash or checkable bank deposit, right? Or in other words, can be converted into something you can immediately use for transaction. Okay, so this is M1 and M2. Now let's look at this practice question. Which of the following assets would you classify as being most liquid? A demand deposit. B, a small deposit. C, a home. D, gold. So C and D, certainly they are not liquid. A home, so in order to develop in order to get a value from your home, what you need, you must sell the house, right? So it is not liquid. Gold in modern days is also not liquid, right? In order to divide the value of the gold, you must sell your gold. So then you can use the money from selling the gold to buy goods and services, right? Because if you go to bakers, so the baker is not going to accept your gold, even though everyone knows the gold you have has lots of value inside, but nobody's going to accept your gold as medium exchange, right? Small time deposit, just think about, so you have a deposit in your bank, okay? And so it specifies you can withdraw your money in 1 month, and as a return, you get an interest rate of 0.5%. So this is small time deposit. And the demand deposit is close to the money in your checking account. You can write a check, okay? So that's A. Now, next question we are going to do is to understand if only half of M1 is currency, where does the rest of money supply coming from? Now maybe we can go back to the figure we have saw earlier, right? It's here, right? So on the left hand side is M1. M1 is just money. Now, this is the most liquid form of money. But in M1, so only less than half is currency in circulation or currency. And more than half coming from bank deposit. Okay, now we need to understand how bank creates money. And so we also need to understand so why we consider this as money. Okay, so that's our next task. Okay, so this is written in these slides. Okay. Okay. So we need to understand how does the banking system creates money. But before we can understand how does the banking system creates money, but we first need to understand the business model of a modern bank. Okay. Bank essentially are financial intermediaries. What does intermediary means? It just means a middleman. Okay? Banks are financial middlemen who use liquid assets. Okay, what is liquid assets? Just think about bank deposit. Okay, so they use these liquid assets to finance the illiquid investment of borrowers. So in other words, the bank is a middleman between saver and the borrower. Who's saver? So saver has extra money, currency they don't want to use today. But then they worry about if I keep my currency in a shoes box or put underneath my mattress, and then the thief may still steal my money, or the rats may eat my money, right? And then so we put in the bank. And who are the borrowers? Borrowers who don't have sufficient money to pay what they need. Either this is to pay for the food, the rent, or if they have a great business idea, so they want to invest, right? So the saver and borrower, most of the time, they have a hard time to know each other. They cannot trust each other. It's difficult for them to meet each other. And then, so in the middle, we have bank. And the bank essentially attract money from saver and then lend the money to the borrower. And then the bank is going to charge a different interest rate. Okay, so the saving interest rate and the lending interest rate. So this difference makes some profit. So that's why we need a bank, or that's how bank can exist. And why there's a difference is because so safer, so they cannot find a borrower or they cannot trust a random borrower. Right? So they must rely on the bank. So then they are willing to pay to receive RS less than RL, because the bank is going to bear the bank is going to incur some risk. Right. So that's the this is the business model for a modern bank. Now we need to understand how bank can create money. Okay, so let's first look at bank's balance sheet. Okay, or take a closer look at how bank works. So this balance sheet is coming from accounting, right? So this is called T account. So this T account, you have assets, and then so you have your liability, right? So in this example, they are not balanced, or so this is not clear, right? So in the sense, assets larger than liability, but in reality, your asset must equal your liability. Okay, this is only for illustration purpose. So the bank's liability is deposit. That's a typical deposit. This is a typical liability for bank, right? It's a deposit coming from savers' money. The saver put their money in the bank, and the bank issue a deposit certificate to the saver, right? So that just literally just says, so the bank owns the saver $1 million in this case. Now with this $1 million, what the bank is going to do? So they will lend out, but here, so they lend more than that. So this implicitly means, so maybe the bank has some capital, which means the money from the banker themselves. Okay, all right. So the bank makes loans. The loan is the bank's asset. Like that is the claim for the bank. So whenever the loan is mature, and then so the borrower has obligations to pay the loan. And what is a reserve? Reserve is a fraction of the deposit the bank must set aside. The bank must put in their account in the central bank. Okay, and so this reserve is designed to avoid bank run. Okay, and what is bank run? So essentially, just in case the bank cannot pay their liability. Okay, so how we understand bank run? Just imagine if there's a local bank, they have 1 million of deposit. And then so they put all their deposit into a loan. Think about a construction project. Okay? And so what would happen? So this project turns sour. Okay? And this bank lost their money. Now the depositor comes to knock the bank door, ask for cashing out, or ask to withdraw the money. And then the bank has no money because all the money went to this soured loan project. Okay? And then this reserve is designed to avoid such terrible situation. Just in case if you have depositors come to knock my door, I still have a certain amount to pay. Just keep the business afloat, and hopefully, so I have another loan project will make me some profit, and then so help me to go through this difficult time. Right? So this is how the bank do their business. And so I just explain you through this key account. Right? So now let's just take 5 minutes.